Observe this uptrend. The chart climbs steadily, maintaining a clear rhythm, until the price violently snaps downward, breaking through the most recent swing low. For most retail traders, this is a clear signal. The broken low suggests a change of character, implying the upward momentum has died and a trend reversal is underway. The immediate response is to sell, but the market has a different plan. Almost immediately after the break, the price reverses and surges upward, continuing the original trend and leaving those who sold short with a sudden loss. When we zoom out, we see this sequence repeating with such regularity that it reveals a deliberate design in the market structure. These spikes and dips are not random occurrences. This specific engineered trap is known as inducement. Without the ability to identify inducement, a trader effectively serves as liquidity for larger institutional players. This turns even a technically sound strategy into a cycle of consistent losses. To understand why, consider the massive scale of institutional capital. These banks move amounts of money that dwarf the combined trades of retail participants. This size creates a problem. An institution cannot execute a massive buy order unless there is a corresponding number of sellers ready to take the other side of the trade. To solve this, institutions leverage the patterns found in trading textbooks. They intentionally trigger false trend reversals to herd retail traders into selling, creating the liquidity the big players need to buy. We map this by identifying a break of structure. In an uptrend, this occurs every time price climbs above a previous peak. Inducement happens right after this break. It's the moment price dips down to break through the first valid pullback following that new high. This dip functions as a targeted sweep for liquidity, gathering the momentum required for the real upward push. Identifying this trap requires two specific technical rules that separate a real trend change from a liquidity sweep. First, consider the break of structure. To confirm a trend, a candlestick's solid body must close clearly above the previous high. However, inducement remains valid even if a thin wick briefly pierces the level. A simple tap triggers the trap. The second rule, which acts as a crucial filter for traders, is the left side rule. After a major peak forms, the chart becomes noisy, with small, erratic movements clustering on the right side. This internal structure is usually misleading. A valid inducement must be the most recent pullback formed strictly on the left side of the current peak. If the price action fails to reach and break that specific left side pullback, no inducement has occurred, regardless of how much the price moves on the right side. By applying the Wick Exception and the left side rule, you can stop mistaking random market noise for institutional intent. This approach treats the chart as a strategic map, where price movements reveal the intent of large-scale participants. In this framework, a higher high is only considered valid once the inducement level has been successfully swept by the price. Success here requires the patience to ignore the initial breakdown and wait for the trap to spring on the rest of the market first. Observing that sweep is your confirmation that the institutional players have secured their liquidity and are ready to move the price. This moment of confirmation provides the safest point of entry, allowing you to align your trade with the real momentum of the trend. Relying on scattered information from random videos often leaves a trader with an incomplete system, missing the subtle rules that make these concepts work. Long-term results come from a comprehensive understanding of smart money concepts. The 30-day Trading Masterclass offers the complete roadmap to help you transition from being the liquidity to trading alongside the institutions. Check the link in the description to begin.